Welcome to my channel, Sensor 360 Investor, where we apply best practices to the investing process. Quick word about the disclaimer. Please read this, pause the video, and take a quick look. Okay, so in this video, we're going to take a look at the markets, and so we'll review what's happening in the market space. Okay, so in terms of the long-term view, here we have the S&P 500, and we can see that the markets have come down again to their kind of June lowish areas, but they're sitting on quite a bit of support. So would not surprise me if we get a technical bounce over the next few days or even longer. So technical bounce is definitely a possibility, although the overall trend remains to the downside. So that trend would have to change for us to start to move to the upside. But we are at a interesting point in the markets and could see some upward movement. Okay, so here is the daily view, and it's a little bit, so we can see a little bit more granularity. June lows came and undercut it, took a little bounce, and you can see that we came to this downtrend channel, hit our heads against it, then undercut the prior low here, moved back up into the channel again, pulled back in for a couple of days, and then Friday's big bounce, which was options exploration driven, took us back to the this downtrend resistance line. So we're sitting at an interesting point, and the next couple of days will tell us what will happen in terms of whether we go up and test this next level of resistance, which is between 3,800 and 3,900. So if we are going to make a move up, I think that's the area to focus in to see what happens, whether we can get through that. And if we do, then we're looking at around 4,100 as the next level of resistance. And if we don't, then obviously we continue the main trend, which is to the downside. And here we have the 1 hour view, and we can see last day's action of hitting down here. Market just kind of undercut, hit intraday low, and then moved up. And now, interestingly, we can see this blue moving average where it became downtrending. So this became a point of resistance here. Didn't quite get there, turned away here, and as of Friday's close, we did get above it, but it's not enough evidence to see whether we've really broken through it. So what we want to see is maybe a small pullback to the line and then an upward move, which will suggest that we may have some trajectory to the upside. Okay, then on to a quick analysis of the last 5 days and 25 days. So let's take a look at over a 25-day period. We've actually had 8 days of, I would say, notable selling. And then in the last 5 days, there's just been 1 day, which is probably this day here. And then on the upside accumulation side, over the 25-day period and the 5-day period, they're both at 2, which means the 2 days came in the last couple of days, which would indicate Friday and this day here. So Friday, Thursday, Wednesday, Tuesday, here's a gap up. So it's definitely Tuesday and Friday's action constructive from a price and volume perspective. And then just looking at the up days, down days over a 25-day period. So we had 5 up days on heavy volume and 8 down days on heavy volume. So yeah, there has been some improvement because the number of days with heavier selling has come down, and we're seeing a little bit of an uptick in the buying side as well. So definitely the picture has improved. And that may be enough to see if the market wants to go and test this 38, 3900 zone from where we're at. Okay, so there's one other thing that I want to take a look at here. So there's a book called How to Make Money in Stocks by William J. O'Neill. And this is actually a pretty good read. It's very specific to methodology from that shop, but it does have some good insights. And one of the ways William J. O'Neill describes in this book is in the markets chapter, and he has a system to basically call uptrends and downtrends. So if we look at, so the market's been coming down, and then we get to this low here, which finishes up for the day. So according to his system, this would be construed as day one of a rally, and the low puts a marker in the sand. So we get a rally day. Next day, we actually have a reversal day, but it stops about halfway. Then we have a gap up. Then we have another gap up. So this is day one, day two, day three, day four, day five, day six, and then day seven. None of these days have undercut, so the rally attempt is intact. Now, what he says is that a follow-through day usually occurs between day 4 and day 7. So those are the strongest signatures. Now you can have follow-through days, as far as out as day 11 or even like 17 days out. Once they start getting past 17 days, the chances of the follow-through day working fizzle out. But this one here is right in the sweet spot. So you got a day 7 follow-through day, heavier volume. So, and you have at least like a 1.5% move on the day. And this can happen on any of the indexes. They can use the reaction on the S&P or the NASDAQ or the Dow Jones. So here's the S&P. So we have a follow-through day. So according to O'Neill's system, they would at this stage put the market back into an uptrend state, which then alerts their people that follow that system to begin buying stocks and wading into the markets. So I just wanted to kind of share that with you because there will be a lot of people this weekend. It's quite popular. A lot of people this weekend will be looking to enter positions come Monday. Now, in terms of what we're looking at is we still have strong resistance above, and the 38 to 3900 is where, if this does move up, is likely the testing zone in this market to see, do we have the oomph? And the other thing is that the weight of evidence is still to the downside. So it'll be an interesting week coming up. Okay, so let's take a look at, you can't take a look at the markets without really understanding the bonds and the yields, etc. So here's the 10-year yield index, and we can see how it's basically as the yield has progressed up, now we're up 4.2%. Obviously that's, and over here is the 20-year bond fund TLT. And we can see here how this has just got killed, because as the yields go up, obviously the demand for bonds are going to taper off, or at least the pricing is going to adjust. And so here it used to be like $155 per share. Now it's at 93. So it's lost at least a third of its value. But what's interesting here is it's got a very climactic selling look starting to show up now. It's almost like you've got straight down, now you have a gap, a drop here as well. So we could be reaching a point where maybe this is going to reach a support zone or start to turn around. And the flip side of this would be, then if that's the case, then the flip side would be, this is likely looking like climactic action here. And we can see it's fairly steep going up here, fairly steep up here, and about the same level of steepness. So, but it's almost vertically up at this stage. So I think it's worth paying attention to to these two indexes. And then if we look at just the fundamentals, 10-year treasuries 4.213%. The S&P earnings yield over the trailing 12 months is at 5.12, which suggests, just on a simple relationship between these two, suggests that the S&P is slightly undervalued now. However, if you look at the risk between the two, the differential between the yield on the treasuries and the prospective yield on the markets is not wide enough to want to take on that risk. So even though S&P looks slightly undervalued, I think it's going to be, I'm not getting rewarded for the extra risk I'm going to take by being in the market. So kind of suggests that we aren't done yet. And then here's another view in terms of just the correlation between the 10-year yields and the S&P-Y. So the S&P-Y is this purple line, and the 10-year yield is the green line. And we can see that pretty much as the yields start to move up, then the markets kind of, with a slight lag, come down. And then as the yields came back in, market had a little bit of a rally. And since then, the yields have been moving straight up. And now we see the market's kind of starting to, they haven't continued to go down. So we're starting, so there's a level of divergence now that's starting to occur between the market action and the yields. So that also suggests that we could be at a zone where support kicks in and there could be meaningful action to the upside. So a lot of different ways this market can go. So, but we'll track it and we'll watch for it and then make our trading decisions accordingly. Okay, so let's take a look at the earnings watch. So here are some notable earnings coming up. And what I've done is I've updated the chart to show you consensus earnings estimate. Now, consensus earnings estimate can vary slightly depending on your data source provider. So I just wanted to hold that out. And then the prediction here is relative to this set of numbers. Some other data provider may differ slightly, so that could change the predictions. So for the report dates here, report dates can vary because companies do sometimes change their earnings reporting date. So just keep an eye on that. But so we're saying Enphase, CMG, ExxonMobil, Apple are all expected to beat their consensus earnings. And then Amazon, Align, and Microsoft are expected to miss now. So it'll be interesting to see how this pans out once they finish up the reporting. But it is useful to keep an eye on earnings because it's earnings that are the driving engine on how Wall Street works. Okay, that is the market update as of 23rd of October. And here's the disclaimer again. So please read through this and I'll give you a few seconds to look down it. Okay, so that wraps up this video. Thank you for listening and watching, and I will see you next time. Bye-bye.